Let's get one thing straight right away. A stock price moving up 300% in just 2 days is not normal. It makes some people very rich very quickly and makes many others feel like they missed the party. This is exactly what happened with SMX. The stock had been trading quietly, then suddenly erupted. On screens everywhere, the green line shot almost straight up. This piece will break down what happened. We will look at the data, and we will avoid the hype. The goal: a calm, clear explanation of the forces behind this explosion. Not advice, just understanding. Key statistics. First price jump, approximately 300% in 48 hours. Second trading volume, monumentally higher, many times the daily average. Third significant short interest, many traders betting the price would fall. So, what exactly is a short squeeze? Let's break it down without the complicated jargon. Imagine you are certain that a particular stock is overpriced and its price will fall. To profit from this belief, you can short it. This means you borrow shares of the stock from a broker and immediately sell them on the open market. Let's say you sell them for $10 per share. Your plan is to wait for the price to drop to, say, $5, then buy the shares back at that lower price. You return the borrowed shares to your broker and pocket the $5 difference as profit. It's a bet on the price going down. It sounds simple enough when it works. The danger, however, comes when your bet goes wrong. What if, instead of falling, the stock price starts to rise? If it goes up to $15, you are already looking at a $5 loss per share. If it climbs to $20, your loss doubles. Unlike buying a stock, where your maximum loss is the money you invested, the potential loss on a short position is theoretically infinite, because there is no limit to how high a stock price can go. Now let's apply that theory directly to the case of SMX. The data leading up to the surge tells a very clear story. High short interest, low float, spiking volume. First and foremost, the short interest as a percentage of the float was notably high. Reports indicated a significant portion of the tradable shares were held by short sellers. This created a crowded trade, many participants betting the price would fall. That concentration acted like a coiled spring, storing potential energy. When the price started to tick upward, that spring was triggered. Another crucial piece was the stock's relatively small float. SMX is in a mega cap with billions of shares. Its tradable share count was small. That meant the market for SMX was less liquid. Short sellers buying to cover were competing for a limited supply of shares. That intense competition amplified the upward price movement. Imagine a dozen people bidding on a rare collector's item, the price rockets. Then there was the catalyst. Whispers of positive developments and favorable biotech press surfaced. The news alone didn't justify a 300% jump, but it caused an initial bump. In today's markets, human traders are not the only ones making decisions. A significant portion of trading is executed by sophisticated computer programs, often referred to as algorithms or algos. These systems are designed to scan the market for specific patterns and execute trades in fractions of a second. One common strategy is momentum trading. An algorithm can be programmed to detect stocks that are showing strong upward price movement and unusually high trading volume. When its criteria are met, it automatically starts buying the stock, aiming to ride the wave of upward momentum for a quick profit. This is a crucial factor in modern short squeezes. The role of these algorithms in the SMX surge cannot be overstated. As soon as the initial buying from short covering began to push the price up, it likely triggered the attention of thousands of these automated trading systems. They detected the sharp price increase and the spike in volume, and they interpreted it as a strong buy signal. In an instant, these algorithms began flooding the market with buy orders, adding a massive and immediate layer of demand on top of the already frantic buying from short sellers. While algorithms provided the high-speed fuel, another critical force was at play: the retail trader. In the age of social media and commission-free trading apps, individual investors are more connected and influential than ever before. Reddit, X, StockTwits traders share ideas, post screenshots of gains, rally around certain stocks. When a stock like SMX begins a dramatic ascent, the news spreads like wildfire across these networks. The chart goes viral. Discussions about a potential massive short squeeze dominate the conversation. This creates a powerful social phenomenon. This phenomenon is driven by a potent psychological trigger, FOMO. Seeing others post massive, life-changing gains creates an intense urge to participate. No one wants to be the person who sat on the sidelines while a stock went to the moon. This can override caution and rational analysis, prompting a flood of buy orders from retail traders. Each small buy, multiplied across thousands or tens of thousands, becomes a significant force that sustains the rally. It is absolutely essential to draw a thick line between a stock's short-term price action and the company's long-term fundamental value. A 300% price surge in 48 hours is a market event driven by trading mechanics psychology. It is almost never a reflection of a 300% improvement in the company's underlying business in that same time frame. Revenue profitability, the progress of its product pipeline, cash reserves, debt levels, these metrics change slowly and deliberately over quarters and years, not in a matter of hours. The business of SMX on Friday was likely not fundamentally 4 times better than it was on Wednesday. A short squeeze is, by its nature, a temporary dislocation. The price detaches from its fundamental anchor and gets carried away by a tide of technical factors. For anyone watching the SMX saga unfold, the risks are immense and should not be underestimated. The primary risk is volatility. A stock that can rise 300% in 2 days can also fall 50% or more in a single session. Traders who buy late, near the top, often succumb to FOMO and face catastrophic losses. The forces behind the rise, forced buying algorithmic momentum, can reverse just as fast. When buying pressure subsides, a liquidity vacuum forms and prices can plummet. Trading these moves requires a plan, not emotion. Do not chase after a massive move. Define your strategy before you enter. Set an entry point, set a target price for taking profits, set a stop-loss level. Only trade with capital you can afford to lose. This is not for your retirement savings. The SMX surge was a classic short squeeze. High short interest, low float, a catalyst ignited it, trading algorithms accelerated it, retail FOMO sustained it. The price action was largely detached from fundamentals. The biggest danger is buying at the peak. Long-term investors should focus on fundamentals. Traders should acknowledge extreme risk. Know the numbers, have a plan, and never let FOMO be your guide.